This is a lecture from OpenTuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
Chapter 1 deals with what's meant by an organisation and what structures they can have. So here's a definition of organisations. It's a social arrangement which pursues collective goals, which controls its own performance, and which has a boundary separating it from its environment. And a number of kind of key words in there to be looking at. First one, it says a social arrangement. Organizations are made of people, and we are social animals. We interact, we have preferences, we have people in the organization we like, others maybe don't like so much. We have different personalities and so on. And this recognition that there are social arrangements is very important. And early management theory didn't really recognize this very well. It was very kind of militaristic almost. It would you give orders, expect them to be followed, irrespective of whether you thought that was the right thing to do, or whether you were overworked, or and so on. Didn't certainly ask you for your opinion. Later theories of management put much greater emphasis on this social aspect, that we like to be informed, we like to be asked about our opinions, and so on. Collective goals. So a commercial organisation, ultimately the collective goal tends to be profit, but not all organisations are commercial. Charities are organisations, and there the collective goals might be the alleviation of hunger, the provision of education, the provision of food, and the like. Controls his own performance. Yes, we look at our own performance, and we, generally speaking, what you have is some sort of target or budget, and a well-managed organisation will keep under review how it is proceeding towards that target, and it will modify what it does, if necessary, to try and achieve the target. And it has a boundary separating the organisation from the environment. We know who is in the organisation, we know who is outside the organisation, we know whom we can give orders to, and who we can't give orders to, and the like. So this business of the environment, this comes from a bit of theory called systems theory. We didn't go into it very much. But systems theory sees that you have the organisation, then there is, around the organisation, there is a boundary separating it from the environment. And generally speaking, there's input that goes into the organisation and output that comes out. So if there was a manufacturing company, you have the factory, if you like, in here. You have the suppliers, the customers, the government, and so on outside. And the manufacturing organisation would take in raw materials, input, and indeed energy from energy suppliers. It would process them within the organisation, manufacture goods, and these then would be distributed to customers. Why is this important? Well, it's important anyway to know who's within the organisation, who isn't within the organisation. And furthermore, the whole organisation then tends to be broken into little subsystems. So within the manufacturing organisation, you would have part of it which deals with purchasing, the purchase of raw materials, part of it which deals with manufacturing, part of it which deals with sales. You'd have another subsystem which deals with accounting, maybe another subsystem which deals with IT and so on. And all of these have their own inputs and outputs. And it's important to know where the boundary is, because when it comes to ordering more stock, more raw materials, who should do it? Should it be somebody who's in the stores, in the inventory, who sees the levels going down? Or should it be someone in manufacturing who sees we've got all of these sort of orders coming in, we need to place an order for raw material? It maybe doesn't matter who does it, but it's important that we know which person has that responsibility. In theory, there are certain systems which do not interact with their environment. There's no inputs, no outputs. They would ignore what customers want, for example. And by and large, these organizations have no long life. They're more of a theoretical curiosity. Organizations which do interact with their environment, take input in, produce output, those are known as open organizations. The ones which do not interact with their environment, in other words, a temporary type of organizations, are known as closed. Types of organization: you can have commercial, they could be sole traders, a person starting on their own; partnerships, where several people work together with a view to profit; limited liability partnerships, limited companies. Great thing about limited liabilities partnerships and limited companies is if that the company goes bust, then the creditors of the company, people owed money by the company, cannot come after the shareholders, if you like, for personal assets. So the liability of shareholders is limited, and in limited liability partnerships, the liability of the partnership is limited, the liability of the business is not. You can have not-for-profit organizations, like, for example, charities. They have some other goal other than profit-seeking. Public sector organizations are owned either by the government or local government, central government or local government. Very often they're not for profit. Health services, the defense industry, or the army, if you like, is not a profit-seeking organization. But sometimes they are. Sometimes in some economies the public sector owns, let's say, airlines or bits of the car industry. These are nationalized industries. And they would generally be expected to make profit, though often in the public sector context they did not. You can have non-governmental organizations like Greenpeace. So they're not run by government, they may be sponsored by government, they may get money from government, but technically they are independent. And then there's cooperatives. This is a bunch of people working together, cooperating in some enterprise, generally sharing the profits at the end of the period. So here are the organizational structures. First of all, we have got entrepreneurial. And entrepreneurial is a very simple organization. An entrepreneur is someone who starts a business. So we're looking here at a relatively young business and therefore a relatively small business. And really what you have in an entrepreneurial structure is the boss and maybe a couple of workers. But there's no complicated structure. It simply isn't big enough to have that. It simply hasn't evolved towards that. Functional structure is very, very common. Typically what you have in a functional structure is you have the CEO, let's put the CEO here, the Chief Executive Officer here. And then you have the board. So here we have maybe the finance director. Here we maybe have the manufacturing person. Here we have maybe sales and marketing. Here we have maybe IT. There may be some other ones in there as well. And then under the finance director, maybe it splits into management accounting and financial accounting. And then kind of below that, you have, chief accountant, assistant accountant, somebody in charge of the receivables, somebody in charge of the payables, and so on. In sales and marketing, maybe it's split in some way into marketing two major types of product which they have, and so on. But the essential thing is that you are grouping together people who carry out, if you like, related or similar or indeed identical functions. And it's very efficient. You get great economies of scale. All the accounting goes through the accounting department and so on. You can get great expertise within that. And it's a terribly, terribly common way to structure organizations. And in your notes, it has there a list of the major functions within organizations, like ordering and purchasing, manufacturing, production. If you're not producing instead of manufacturing, you may be in direct service provision. So a firm of accountants does not manufacture, but it provides accounting services. Sales and marketing, that's finding customers, finding what they want and then selling to them. Distribution, we might have our own fleet of lorries and vans and look after it ourselves. General admin, record keeping and so on. Research and development, human resources, looking after the recruitment, training, retention, appraisal and the like of your people, your employees. Accounting and finance. We have got also in some larger organizations, we have a specialist department looking after, in particular, cash. And it can be sometimes called a cashier's department, making sure the cash flow is okay. Or what we might have is actually a treasury department. And the treasury department looks after, if you like, the big things surrounding funding. Do we need to go to the bank and negotiate a loan for September? How are we going to deal with this large amount of dollars which is going to be coming in 3 months? How are we going to deal with the exchange rate fluctuations and the like? So the functional organization is very, very common. Now what I'll do, just before we get on to matrix and boundaryless and so on here, let's just look at divisional structure here. What a divisional structure says is we're now so big, we're operating in North America, we're operating in Europe, we're operating in Asia. We're really dealing with different competitors in those three markets. We may be making slightly different products. There are different laws and rules and regulations in those three markets. Does it really make sense to have only one sales and marketing department or only one manufacturing department? And what divisional organizations do is they would say, well, here's our American division, here's our European division, here's our Asian division. Within that, we would have purchasing, we'd have manufacturing, we'd have sales and so on going through this. So there's a certain duplication going on. We now have several manufacturing plants, several sales and marketing, several kind of purchasing departments. But the idea is that you get specialism. You have people who know in the sales department, they know exactly what the US customers want and what sort of competition there is. In the European division, we know exactly what those customers want and so on. Here we've divided it up in terms of geography. It doesn't have to be in terms of geography. You can also divide it up in terms of major product categories. So in the UK we had a major chemical company and it made agricultural chemicals, basically fertilizers, and it made paint. Now there's really hardly any overlap on those skills or on those customers. So they had their agrochemicals division and they had their paint division and they became specialists in that. Matrix organization, slightly different. We just draw one here. Matrix organization, a good way of thinking of it is you've got project A, project B, and project C. In each of these you've got a project manager who's responsible for bringing in the project on time and to budget. And then we have a number of functional people across here. We maybe have engineering, we have maybe manufacturing, maybe have quality control, and so on. So we've got project teams made up of a mixture of skills, people from each of these disciplines. And what we have, for example, is a quality control person who's working at the minute on project B and who reports to the quality control manager. So this sets out a kind of two-dimensional matrix rather than just going down within one department all the time. And this recognizes that this person has got dual responsibilities. Responsibility to the project B manager to make sure or to help the project coming in on time and to the right quality. and a kind of technical responsibility to quality control to make sure that the building, the production, whatever it is of the right quality. Now, classically, this was regarded as being a bad setup to have, in a way, to be responsible to two bosses, to potentially two people shouting at you, and maybe trying to pull you in different directions. The project B manager says, speed it all up, we need to get it finished on time. The quality control manager says, now take your time, do the quality control checks properly. And this is putting this poor employee under this great tension between two managers. Myself, I think this depiction of what's happening, the matrix organization, is honest. And what it allows this person to do is say, look at the matrix. I'm responsible to you and to you. If there's a problem in getting the project completed on time because the quality control tests are going to take too long, why don't you two managers sort it out? You're the ones who are more senior with the most skills, but don't shout at me. Don't expect me, in a way, to make my decision on the basis of the manager I fear most or who shouts louder. That's not any good way to make a decision. So matrix organizations are supposed to emphasize kind of cooperation between different, I suppose, requirements, different targets within the organization, and should allow it to be sorted out any tensions at a higher level. Boundaryless, virtual, hollow, modular, these are more modern types of organization. They're all covered in the notes. I'll just talk about virtual here. So some IT companies, for example, Apple, doesn't make its own phones. Apple is fantastic at design and fantastic at developing technology, but to some extent then clipping these bits and pieces together to make an iPhone is not something which adds value particularly. It's a very repetitive, say it's a low skill task is pushing it a bit, but it's not the clever task. So what Apple does is says, right, we will maintain the elements which give us our edge, the design and development, and we will subcontract the manufacturing, and we will subcontract the distribution to a company, logistics company like DHL or TNT or something, or UPS, something of that sort. So what virtual companies do is they reduce themselves down to where they have real, genuine expertise, and everything else tends to be subcontracted. Everything else, to some extent, is a necessary evil, but it's not clever, and we just want to give it to people who are going to do it very well and very efficiently. And so we maybe subcontract manufacturing to a huge manufacturing organization which is based somewhere where labor costs are low. Mintzberg Structures, kind of curious, you need to know what's going on here. Mintzberg divided up the organization into 5 bits. Strategic apex, think of it, strategic and apex. Apex is the top, strategy is looking long term. Basically, this is the board. Middle line is, think of middle management. So there'll be a number of managers going down this middle line. Operating core, think operating machinery. These, if you like, are the workers. We have support staff, people who do word processing, people who look after accounting, people who look after the wages and salaries and so on. If you like, basic administrative tasks. And then the difficult one was the Tecna Structure, and Mintzberg said this is the people, and it's not just one department. These people come from a number of departments, but they develop, if you like, standards, procedures, kind of manuals, guidebooks, and so on. So within large organization, you have got quality control procedures, you've got quality control standards, you've got health and safety rules and regulations, you would have standards, manuals, if you like, employee handbooks, if you like, telling people, their entitlement to holiday, what to do if they're sick, what's going to happen if they're not performing very well, and so on. As we've drawn it here, this is what's known as a machine bureaucracy. All of these are going to be quite big. In particular, the Tecna structure is quite big, because in a machine bureaucracy, which really means mass manufacturing, it's very important that we do take health and safety issues very seriously in a factory. It's very important that if you're making cars, you make them in a very consistent way. So there'll be lots and lots of rules and regulations about how to actually go about manufacturing, how to test for quality, and so on. So the Tecna structure is quite large. What Mintzberg did was he says this is going to vary. The importance of these elements is going to vary depending on the sort of organization you have. So an entrepreneurial organization, that's the very small one we talked about earlier, is just going to have the boss and basically the workers. It's going to be a bit like that. There is no support staff. It's far too small, far too young. There's no Tecna structure because people haven't really got around to writing the procedures, manuals, and so on. So basically it's the boss and the workers. He then talked about a professional bureaucracy, professional in terms of a professional company, a professional firm like accountants or like lawyers. And where should I write this? Where do we have room? We maybe got room in here. I'll get rid of this. What he said there was quite kind of interesting in the professional bureaucracy. It came out a bit more with this sort of a shape. So the middle line was small. You had obviously lots of people at the bottom going out doing audits and so on. You had a reasonable sized admin, but a tiny Tecna structure. He said, why has the kind of shape of the organization changed? And the shape changes because if you're in a firm of auditors and you've basically got the partners at the top, and it's the people at the bottom who go out to the client and do the work. And the partner wants to talk to these people because every audit client is unique. The partner wants to hear firsthand, how did the audit go, what problems were there, are there any figures in these financial statements you're not so happy about, and so on. The partner doesn't want this information, if you like, filtered through lots of layers where it's going to get distorted. So there's a very kind of small hierarchy, if you like. Also, the Tecna structure is small because although auditors have got standard documentation to fill in, the way it is filled in is going to be unique to each client. Similarly, in a firm of lawyers, every case that you might be assigned to has got its unique set of facts and unique arguments you can make on behalf of your client. So you can't standardize taking on a law case the way you could standardize making a car. You can't standardize an audit in a way you could standardize making, say, a camera, where you're making thousands the same, each is unique. So the power of the Tecna structure is relatively small. Levels within organizations, strategic. Strategic is really the board. Think of, every time you see the word strategic, think of about 5 years. These people should be taking a kind of long-term view. Where's the organization going to be in 5 years? What's it going to be up to? What's it going to be doing? What sort of technology is it going to be in? Operational is basically day-to-day. These are people who do the work, who record the sales, who record the dispatch, who record the goods coming in, and so on. Think of that as who get on the phone to a customer and try and sell them stuff. This is an operational level. It's day-to-day activities. And then we have, it shouldn't say technical, it should actually say tactical. Tactical level, not the technical level, the tactical level, think of this as about 1 year. So strategy and tactics. Strategy is long-term, tactics is shorter. Think of this as a manager who is concerned with making their budget. And usually the budget will be, the year's results and so on. They are concerned with controlling the costs and the sales and so on within a relatively short period. But they're not going to be making big changes. That's for the strategic level. Recent kind of changes we can look at now a little bit, and indeed the shape of organizations. So the tall, narrow, wide, flat. So a tall, narrow organization, you've got many, many layers, hence tall, and narrow. What we have in this very regular organization is every manager looks after 2 people. That's known as a span of control. So every manager is looking after 2 people. The wide flat, it's got many fewer layers, but the span of control, well, here's 1, 2, 3, 4, 5, 6, 7. Span of control is the number of people reporting directly to you. Here the span of control was 2. There has been generally a movement that way. And the movement that way for 2 reasons. First of all, if you're looking after 2 people, it gives you an awful lot of opportunity to almost redo their tasks. And there's a lot of checking up on people which is maybe not actually needed. Close supervision is possible, therefore you do it to keep your job. And people began to think, well, where's the value added in this? We've got senior managers, supervising senior supervisors, supervising supervisors, supervising assistant supervisors, and so on. All of this kind of duplication and wasted effort, it's costing huge amounts of money, which is really not justified. So let's get rid of these middle managers and save money. The other reason it's moved this way is that change was very difficult in tall, narrow. By and large, all these layers have their own little perks, what sort of car you got, what sort of holidays you got, maybe whether or not you got into a certain canteen within the organisation, what sort of holidays you got, what sort of healthcare you got. They all came attached with their little perks, basically, and people were very defensive about them. And that made shifting and changing the organisation, people would dig their heels in to preserve what they had. It also meant that communication up and down the organisation was jeopardised, because you tell your manager, they would have to interpret what you said and pass it on to the next manager and so on. A bit like, the game you played as a child when you stood in a circle, you whisper something into this person's ear that goes round, comes out completely different at the other side. And with increasing speed of technological development, it could be the new person at the bottom who knows stuff, let's say about social media, about Twitter, Facebook, Instagram and so on, that maybe the traditional chief executive officer, a much older person, would not know about. And there should be much better communication horizontally or vertically. And again, here with fewer layers, the communication is much better, much more reliable, and also it's suggesting teamwork. You're all much more egalitarian in a single layer. So shifting responsibilities around, forming teams, disbanding teams, reforming teams, and so on, should be much easier, so you can respond quickly to market developments and technical developments and so on. Centralization and decentralization shows where power lies in the organization. If something is not decentralized at all, it strictly means the person at the top looks after every decision, both important and trivial. And the problem is that they will not have time to do that properly. So decisions will be delayed. They may not have the expertise. Why should a single person at the top be able to make decisions about IT and about advertising? It's not very motivating for other people if you can never make any decision yourself. And if you never make any decisions yourself, how are they going to decide whether you're any good or not if you're just following instructions? So some decentralization is good. Faster, better decisions, more motivating for staff and so on. The potential danger is poorer coordination. One person makes a decision, good for their department perhaps, but which is harmful to another department. So some sort of overview really needs to be kept within decentralized organizations. Recent trends, downsizing just means getting smaller. Delayering, that's going from tall, narrow to wide, flat. Outsourcing, that's like the virtual organization where you get other people to do certain aspects of the manufacturing to you. Offshoring means going abroad. Either move your factory abroad or outsource to people who are abroad, where it may be cheaper or maybe better. Shared services is where if you had, let's say, a firm of lawyers, let's say they were in 6 major cities, instead of each of the offices having its own billing department and invoicing department, you say, right, we're going to have the accounting department in city 1, and everybody else sends in the information to that centralized accounting department, and all 6 offices share the expertise, the services provided by that central department. And finally, we have formal and informal organizations. Formal stuff is basically what's written down. So the organization chart, probably written down. Procedures manuals, written down. A mission statement, kind of saying what the organization is for, what its values are, written down. Staff appraisals, written down. Your training record, written down, and so on. This is all the stuff management knows about and management causes or is responsible. However, the idea came that there's a lot of other stuff going on within organizations that management is not in control of and management might not even know about. And this diagram, it represents an iceberg. And you know in an iceberg that the majority and the dangerous part is the bit that you can't see. It's hidden underwater. And similarly, down here we have all the informal parts. Like alliances, people that you are friendly with. So no matter what management says, you're friendly with this person, maybe you tell them information you shouldn't. There's rumour and gossip, terribly powerful. You know, the chat round the coffee machine and so on. People often get the wrong end of the stick entirely and get worried about job losses when maybe they're not talked about. A group norm, a kind of informal agreement about, say, how hard you should work. And if you begin to break a group norm, if you know, most of your colleagues are making 20 items a week, and you manage to make 30 items a week, they're probably not going to like you. And there's a lot of pressure on people to not rock the boat, if you like, to behave in a generally accepted way, which can be very resistant to management efforts to change it. There may be personal ambitions. So you may be in the accounting department, but maybe you would kind of quite like to have a go maybe in sales and marketing, you know, something radically different. But during the staff appraisal, maybe you feel that that's being cut off in some way. And if you feel your personal ambitions are not going to be met in one organization, maybe what you do is to move to another organization. And that may well impoverish your old employer.